Fresh data from the COT report shows that smart money is positioned for the Fed meeting. We're going to show you what this means for stocks, bonds, gold, and a possible Forex trade. In blue, that's a dollar Swiss currency pair, essentially the US dollar. It's been trending low over the past couple months. In yellow, that's the net position held by asset managers. They've been trending lower together, actually, very highly correlated. Now, of course, we're talking about the COT report. This is a commitment of traders report. It's issued weekly by the CFTC. It shows the largest positions held in the futures market, held by traders, hedge funds, banks, farmers, the players in the market. Now, it shows us market sentiment, shows us really where the big players are, whether they're bullish or bearish. And sometimes it gives us trend signals, changes in positions, trend reversals. And essentially, it shows us where the smart money, those that know these markets the best, how are they positioned? Well, there's several different categories within the COT report. We're going to focus on the asset managers, otherwise known as managed money. This includes speculators, hedge funds, and commodity trading advisors. Now, they trade for profits, so there's no direct interest in the physical commodity. They buy if they think the market's going to go up, sell short if they think it's going to go down. Now, we're going to show you a number of different categories here, but we're going to focus on the asset managers. In green, those are the long positions. In purple, the short positions. We also see the dealers. These take the other sides of the trade. Now, this is not so important because it's a little bit more difficult to interpret their positions. But let's look at the asset managers because they are highly correlated to the markets. So again here, the same chart in blue, dollar Swissy trending low over the long term. And the asset managers' net positions, those are the long positions minus the shorts. They are highly correlated. Asset managers tend to have the best read on the markets. We're going to show you exactly how this works. Now, the COT report shows us what we're going to show you in just a moment, that the long positions in the US dollar, they're declining. The short positions, they're rising. Overall, the short net position on the US dollar held by those asset managers is increasing. Here's the US dollar. It's reported every week, so these are weekly updates. In green, those are the long positions. Last week, the asset managers held 3,400 contracts. Now, 1,800. Their long positions have declined. During the same period of time, their short positions have risen from 9,000 up to 10,200. So when the long positions decline and the short positions rise, net net, we see a larger short position, again, on the US dollar. Now we compare the US dollar declining to the Fed cuts and the probability that will happen. In blue, that's a probability in October that the Federal Reserve will have cut rates by half a point. In red, that would show us a quarter point cut. Again, we have a September meeting coming up that's almost an assured probability that the Fed's going to cut rates. So now we're looking out to October to look for a little bit more nuance. What we've seen in the past couple of days is a little bit of a pullback. I'm sure you've noticed the stock markets have been a little bit tepid, moving from 87% down to 74% chance of a half a point cut or half a point lower than where we are now. But still, the overwhelming majority opinion, the Federal Reserve will cut rates by a quarter point in September and another quarter point in October. Now, aside from the declining US dollar and Fed cuts, we have other sources of confirmation, such as falling Treasury yields. Now, there are different maturities. The shortest term maturity, that's the 13-week. That tends to move very close with the anticipation of Federal Reserve decisions. The longer term maturities tend to move in anticipation of longer term growth or inflation. And what you'll notice is the 13-week Treasury, top left-hand side, that's now below 4%. That was a big level. In fact, we're at 390 at the moment. And that really is giving us a lot of confirmation that the Federal Reserve is not only going to cut rates in another couple days, but this is the beginning of several rate cuts to come. Now, the asset manager's long position in the bond market, we just showed you the yields are going down. Of course, there's an inverse correlation. When yields go down, it means the bonds are going up. Well, do the asset managers agree? Absolutely. In green, those are the long positions, 3.07 million contracts long U.S. Treasuries. Now, these are the 10-year, these are the medium-term maturities. And what you'll see here is that overwhelmingly, there's a long position in the bonds. Again, if they're long bonds, they're betting that yields are going to go down because bond prices move opposite of yields. So this is extra confirmation that yields are going down, bonds are going up in conjunction with the falling US dollar. In conjunction with the fact of the matter is stocks are rising. Stocks like the probability of lower interest rates. It makes business easier. Here's the asset manager positions for the Dow Jones Industrial Average. Again, in green, take a look at the positions, how they've changed over the past week. From 14,000 long contracts now to 19,000. The short position stayed at 11,000. So this is showing us that the smartest money out there, those that know the markets the best, are betting that stocks will continue to rise, a little bit more actually than last week. Now, over the past couple of weeks and even more, stocks have enjoyed a very strong trend to the upside. Top left-hand corner, that's a VIX, the volatility index. That moves opposite of markets. So we have a lot of confirmation here. Yields are pointing lower. Obviously, the bonds are pointing higher. The dollar, Federal Reserve probability of interest rate cuts, they're all in agreement. Now, aside from the US dollar declining, Fed cuts, falling Treasury yields, rising stocks, we also have a very strong metals market. Of course, we're talking about gold and silver primarily. They've been on the rise. Metals tend to move opposite of the US dollar. When the US dollar falls, we lose buying power. Well, traders and investors will buy gold and silver to preserve our buying power. Take a look at silver, $42.39 an ounce on the close. By the way, bottom left-hand corner, copper. That's at $4.59. Now, copper moves for different reasons. It's a lot, influenced by industrial production, manufacturing, that sort of thing, but also tends to move opposite of the dollar. So now we see the commodity market giving us extra confirmation that the asset managers have the right position. What about a Forex trade? Now, the Forex trade involves two currency pairs. We have the US dollar. The asset managers, they say it's going lower. So we take a look again. The long positions have declined from 34 down to 1,800. Short positions have risen from 9,000 to 10,200. What about the other side of the trade? Here's a New Zealand dollar. And take a look to see what's happening. From last week's long position of 16,800, that's risen to 18,300. The short position has declined from 21.9 to 21.4. Now, net, there's still slightly a larger short position than long. But what you'll see going back over the past 4 weeks, actually, take a look at August 19th. The long positions were only 12,100. Every single week, the asset managers are adding to their long positions. Now, true, the short positions did rise, but now it looks like they're starting to decline. So when we take an already very weak US dollar and New Zealand dollar, which was weak, but it looks like it's strengthening, we have the probability or a possibility of a reversal. Take a look at this correlation. In blue, that's the New Zealand dollar against the US dollar, the Kiwi dollar currency pair. That's been rising over time. In fact, over the past couple of days especially. In yellow, that's the asset manager's net position on the New Zealand dollar itself. And what you'll notice, again, very strong correlation, and they're both pointing to the upside. Now, again, to be clear, there's still net a short position in the New Zealand dollar, but less and less. If we believe this pattern to continue, this trend to continue, a weak dollar and a strong New Zealand dollar, logic dictates the Kiwi dollar should continue to rise, maybe even develop a new uptrend. That looks like what's happening right now. Now, we spoke about a phenomenon in the market calling a steepening yield curve. We wrote about this in our Substack newsletter. We'll provide a link in the description of this video. And essentially what it shows is a widening of the curve between the long and short ends of the bond market. The 30-year, the bottom right-hand corner, that yield's been rising. Now, recently it's declined, but I would say not as much as the shortest term, the 13-week Treasury. But here we discuss two different situations where the steepening yield curve could be a precursor to an economic recovery. It can also be a precursor to a recession. Here we detailed in this article the differences between the two. We hope this has been helpful. We look forward to seeing you back soon.